The American financial system is on the brink of collapse. We're at a point where the next crisis could be far bigger than anything we've ever seen, and it's no longer clear if we have the tools or resources to stop it. What's coming next isn't just a financial crash, but something more systemic, a collapse in confidence in the very foundation of our economy. I'm not talking about just another bank failure or stock market crash. I'm talking about a deeper crisis. The moment when people lose faith in the currency itself, when the dollar, the bedrock of global finance, comes into question, the issue is no longer whether or not a bailout is possible. The real question is whether these institutions, like the Federal Reserve or the European Central Bank, even have the capacity to manage another financial disaster. In the past, central banks have stepped in with bailouts, propped up failing institutions, and injected money into the system to calm the panic. But every bailout requires more resources than the last. And now, we may have reached a point where the size of the bailout needed is bigger than the central banks themselves. They've played all their cards, pulled all the rabbits out of the hat. What happens when there are no more tricks left? Take the Silicon Valley Bank collapse, for example. It was the biggest bailout in U.S. history, and it shook the entire financial system to its core. The FDIC swooped in, but even then, it was clear that this wasn't your average bank failure. The collapse set off a panic, not just among tech startups and venture capitalists, but among some of the largest corporations in the world, like Roku, eBay, and Cisco, all of which had billions tied up in that bank. Suddenly, people were scrambling to move their money as fast as they could. Technology made this panic happen faster than ever before. What used to take days or weeks now happens in a matter of hours. With a few taps on a smartphone, billions of dollars can disappear from one institution, setting off a chain reaction. Peter Thiel, one of the most influential figures in Silicon Valley, sounded the alarm early. He didn't just pull his own money out. He sent out a message telling everyone in his network to do the same. And they did. Within a short span of time, over $40 billion was pulled from the bank. The result? A full-blown liquidity crisis. The time frames for financial crises are shrinking, but the impact is growing larger. This kind of speed means that the traditional methods of handling a crisis, like bailouts, takeovers, and policy shifts, can't keep up. The response from regulators, which used to buy them days or even weeks, now has to happen almost instantaneously, or else we risk a global financial meltdown. And it's not just about banks collapsing anymore. The real crisis is looming over the US dollar itself. As the dollar weakens, the euro, which is tied closely to the US economy, follows suit. But here's the problem. You can't bail out a currency crisis with more currency. It's a paradox. Pumping more dollars into the system when people have already lost faith in the dollar just makes the situation worse. We've seen echoes of this before, like in the Latin American debt crisis of the early 1980s. Countries like Brazil, Mexico, and Argentina were on the brink of collapse, and the crisis lasted for years. But the thing is, those crises were regional. They were isolated to Latin America, and eventually, through refinancing deals like Brady bonds, they were able to stabilize the situation. The intense phase of that crisis lasted 3 years. But even then, it took nearly a decade to fully recover. Now, contrast that with the speed and scale of what we're seeing today. In 1998, when long-term capital management collapsed, it took 3 months to resolve. That was considered lightning fast. But Silicon Valley Bank? That unfolded over just 3 days. From Wednesday to Friday, a massive institution was wiped off the map. One of the most unsettling aspects of this is the uncertainty it creates. I spoke with a guy who manages one of the largest endowments in the world. He told me how they were moving $8 billion out of Silicon Valley Bank. They initiated the wire transfers on a Thursday, but they didn't know until the following Monday whether the money had even moved. For nearly 3 days, billions of dollars were in limbo. Nobody knew where it was. And they weren't alone. Even massive corporations and crypto promoters with billions at stake were in the same boat. It was a weekend of pure uncertainty. The modern financial system is not equipped to handle that level of volatility. In the old days, you had to physically go to a bank, stand in line, and wait to withdraw your money. Today, you can be standing in line at a fast food joint, pull out your phone, and transfer $10 million in seconds. Technology has made everything faster, including panic. But let's talk about the deeper issue. The real vulnerability in the system isn't just about tech startups or even big corporations. It's the structure of the banking system itself. Silicon Valley Bank wasn't just another bank. It was heavily involved in funding the green tech and climate sectors, which are propped up by government subsidies. Many of these ventures are high-risk, speculative investments in things like battery technology or renewable energy. The loans were risky, but they were politically popular because they aligned with the current administration's focus on green energy. Here's the thing most people don't realize. 97% of the deposits at Silicon Valley Bank were uninsured. That's nearly the entire bank's deposit base. Compare that to a healthy bank where around 30% of deposits might be uninsured. Once you get above 50%, you're in the danger zone. If a crisis hits, those uninsured depositors are the first to panic and they will rush to pull their money out. That's exactly what happened here. And this isn't just about one bank. This is a systemic issue across the banking sector. If you want to assess the health of a bank today, don't just look at their assets or liabilities. Look at the ratio of uninsured deposits. If too many depositors are uninsured, that bank is sitting on a ticking time bomb. When things go south, those depositors are going to run for the exits, and there won't be enough cash to cover the withdrawals. This brings us back to the broader economic picture. The housing market, for instance, has been booming in certain areas, especially outside of major cities. Why? Because there's an exodus happening. People are leaving the cities in droves, crime is on the rise, and the things that made city life appealing, like art, culture, restaurants, and bars, have all but disappeared. The pandemic lockdowns magnified all the negatives of city life while stripping away the positives. So people are moving to the suburbs, or even further out to what we call exurbs. But this is creating another problem. Cities are the greatest wealth generators in history. Civilization itself is built around cities. When people leave, they take that economic activity with them. Office buildings, once bustling with activity, are now sitting half empty. Companies are downsizing, cutting back on office space because employees are working from home. This might seem like a good thing in the short term, but it's a slow-motion disaster for urban economies. Think about it. If you're a company that used to lease 10 floors in a downtown skyscraper, now you might only need 2. You cut back on rent, but that also means fewer employees in the office, which has a ripple effect. The cleaning crews, the food trucks, the restaurants, the public transportation systems, all of these depend on people being physically present in cities. If that demand drops by 50% or more, what happens to those businesses? What happens to the city's economy? And it's not just commercial real estate. The same thing is happening in residential markets. As people flee the cities, demand for housing in the suburbs and exurbs is skyrocketing, driving up home prices, but that's only one side of the equation. The other side is that cities are being depopulated, and with that comes a loss of economic vibrancy. It's a slow, steady drain on the economic engine that powers much of the country. But this isn't a short-term issue. The collapse of urban economies and the hollowing out of commercial real estate will take years to fully play out. And it's not just about real estate. This downturn has ripple effects throughout the financial system. Banks that hold commercial real estate mortgages are already feeling the pressure. Tenants aren't paying rent, landlords can't make mortgage payments, and those losses get passed on to the banks. The banks, in turn, have packaged those mortgages into securities, which might be sitting in your retirement fund or 401k. The bottom line is that the financial system is far more fragile than it appears on the surface. We've spent years building up a house of cards, propped up by government subsidies, speculative investments, and cheap money. But the cracks are starting to show. We're seeing it in the housing market, in the banking system, and in the broader economy. Inflation, which was expected to be the big threat, isn't even the most immediate concern. Instead, we're facing a deflationary spiral where people aren't spending, businesses are cutting back, and the velocity of money is grinding to a halt. We're at a critical juncture. The next few months will determine whether we can stave off a full-blown collapse or whether we're heading into uncharted territory.